The following content is for informational purposes only. The views and opinions expressed by the hosts and guests are solely their own and do not necessarily reflect the views of Alia, its affiliates, or any organizations represented by the participants. Nothing discussed should be construed as financial, legal, or investment advice.
Welcome to Market Cap, where we feature firms and funds to explore the thinking that guides them, the patterns they observe, and other forces moving the markets. I'm your host, Stefano, Director of Institutional BD at Alea, and with me I have Laszlo Szabo, co-founder and CEO at Kiln. Kiln is a leading institutional on-chain asset and yield management platform, enabling institutions to generate yield on their digital assets, surpassing 18 billion USD in assets delegated last year. They offer a comprehensive suite of yield products, real-time reporting, and monetization tools that help custodians, wallets, exchanges, and asset managers streamline on-chain operations. Laszlo, welcome to the show. So good to have you with us.
Hi, Stefano. Thanks for having me.
Absolutely. Let's get into it. There's lots of interesting things going on in staking right now and Kiln specifically. So I can't wait to have a conversation about that. Before we do that, real quick, your background, before doing Kiln, you founded Skill Hunter, which is
That's
a
right.
recruitment firm specialized in tech, which I found very interesting. Because I'm always curious what leads people to their current role and what they're focused on right now and how one thing led to the next, right? And I'm particularly curious how you might translate or cross over lessons from Skill Hunter to Kiln.
Right. Yeah, I think, first of all, I did an hospitality school, so nothing related to tech. And the first foods in the tech world was recruitment. So I've launched this tech recruitment company more than 10 years ago in south of France, two of my friends, and kind of a random thing where we would recruit engineers for startups, for scale-ups in large groups in France. And that's when I entered in the tech world. I didn't know what development, engineering, back end, front end, DevOps type of people and stack were. And so I become quickly passionate about tech, from essentially recruiting engineers for the best companies in the country. And at some point I was like, well, I'm a little bit frustrated of not building products with these guys and just like being the pass through to push them to work for a company that do great stuff. So I was like, okay, I want to be on the other side. I want to be that company that employed them and get to collaborate, work with these guys every day. Because when you're a recruiter, you sometimes get a 30-minute call with a super bright engineer, and you're like, well, but I want to work with this guy. I just don't want to need 30 minutes of my day just talking to him. I would be happy talking to him every day. So I was looking, okay, what's next in tech, and how can I have leverage, considering the only thing I knew was recruitment. And I was looking at AI and crypto. I invested into Bitcoin roughly at the same time I created this tech recruitment company. I had in Tokyo back then when I was in hospitality. This guy called Adam Treadman was the CEO of BRD Wallets that I met completely randomly in Tokyo, and started to buy my own Bitcoins. And I was like, okay, Bitcoin is interesting, but then it's really in 2016, when a friend of mine, when I was in recruitment, a childhood friend, would work with for Consensus. So I would go to my friends and say, hey, you're a dev, you're an engineer, what are you doing? And he was like, well, I'm working on Ethereum at this company called Consensus. I was like, okay, but what's Ethereum? Oh, it's a smart contract platform. It's a decentralized computer. Well, what are you talking about? So I started thinking, and I bought my first ETH back in 2016, and then the price went up in 2017, and in the south of France with my co-founders, like, okay, we started. 2017 was so crazy that we started to do half recruitment, half like ICOs and reading white papers and understanding what was about this Ethereum ecosystem. And at the end of the year, I was like, end of 2017, I was like, okay, I'm too pilled. And I was thinking all year, how can I apply recruitment? The only thing I know was blockchains. And at the end of the year, beginning of 2018, sorry, I went back from the south of France to Paris and launched this. In the beginning, we were trying to put CVs on chain. Launched this like recruitment/HR company on Ethereum, and build a bunch of proof of concepts, pivoted so many times, and then led to blockchain as a service and staking later. So you see from from hospitality to staking.
Yeah, quite the trip. And know, and I know that now at Kiln you work with those bright binds on a daily basis, right? So you made it happen, I suppose. And yeah, let's talk a little bit more about Kiln. So of course, people know Kiln. When you hear Kiln, you think, okay, staking provider, institutional staking provider. I think things have been shifting, however, a little bit without getting in too deep. But like, what are you currently offering actually?
Yep. So if you get back in history, we launched our first private blockchain as a service platform in 2019. So Node as a service for companies trying to deploy proof of concept on blockchains. And at the time was private blockchains. Then went into public blockchains and started with our first staking product in 2020 when we were quite late in the staking game. Most of the staking company back then were retail companies, right? They would essentially provide public validators along with the Solana or Cosmos ICO, sorry, and Cosmos and Solana holders will delegate to these validators. So it was very much like a direct retail type of distribution. And that's something that I never really understood. I really understood the B2B play. How can I build products for platforms, essentially? And in 2020, that's what we're started to launch validators for funds on Pocket Network, a small staking protocol, and then on Ethereum, more for platforms like Ledger and then other wallets, other custodians, other exchanges. And we were looking at the space, and the only company who was doing that back then was Bison Trails, was bought by Coinbase. Now it's Coinbase Cloud. And I was like, okay, this I understand. How can we build the infrastructure so that an exchange, for example, one of the platforms I'm mentioning, can offer staking, which is yield, on-chain yield to their customers while taking a commission on-chain. So that's what we do. We provide infrastructure for platforms so that they can offer their customers yields, staking, and now DeFi.
Absolutely. Yeah. You already mentioned the different counterparties that you interact with a lot, right? Exchanges, custodians, wallets and fintechs, and of course, asset managers. Can you tell a little bit more about what it takes what approach does each one require?
Yep. Exchanges needed a validator and then APIs, which will enable them to stake and unstake automatically and get the right reporting, and then plugged into their favorite custodian. And later down the line, wallets needed smart contract because they couldn't offer staking on Ethereum while taking a commission and in a completely non-custodial way without a smart contract. So we started to build on-chain and smart contract product for Ledger, for example, in 2021. And now we work with more than 40 wallets using our smart contract stack. And then they needed to access DeFi. Oh, I'm offering yield on Ethereum, on Solana. How can I access and offer yields on stablecoin? And well, the way you find yield on stablecoin back then, 2 years ago, was lending. So how can I give access to my users to Aave or Morpho or Compound? And so we built Kiln DeFi. It's essentially a front end and an API and smart contract so that they could offer easily lending yields on stablecoin in an easy way, simple way, so that they can take a commission again. And then we thought, okay, but if we are a yield company, what's next in yield, right? What is sorry, where the yield market is going to go? And I think it was clear that the vault structure was going to be the default standard on how you distribute yields on chain in the future. And we thought, okay, how can we make sure we think of a vault structure for our customers that fits the world of DeFi tomorrow? And the world of DeFi tomorrow is going to be, of course, composed of DeFi, native DeFi protocols, but mostly of real world assets, right? Yield and assets of the real world that are going to be presented on chain so that they can be essentially represented and managed into these vaults, which will ultimately generate yield for the end customers. And this is why we built Railnet.
I think that's very interesting that though you offer the same product to all these counterparties, they all need like a very tailored solution depending on their specific infrastructure and the services that they are providing and the needs that they have. So that's very interesting to see that very like specific approach for all counterparties. Talking a bit more about staking and the development, the evolution, let's say. Some would maybe say that staking has become like very a commoditized service, right? How do you stay differentiated?
Yep, that's the core question.
Yeah,
So I think staking is always going to be there, right? It's now the default way to validate transaction on blockchain. Any new blockchain that is launching is usually a staking blockchain. And that's the case of Ethereum, Solana, but now, Arc or most probably Tempo or others, where it's the best way to secure a blockchain and to make it as efficient as possible with the highest TPS transaction per second possible. So staking is always going to be there, and it's kind of the risk-free rate in crypto, where if you own the native assets, you don't stake it, then you lose, or you're being diluted by the network. So there's no reason to not stake an asset if it's a stakeable asset. In the case of ETH and Solana, for example, but then you better do something else with it, because protocols are trying to put the rates down because they want less assets to be staked and more assets into DeFi. So, for example, Ethereum is trying to reduce the inflation of the network and reduce the incentives that gets to the stakers from the transactions that are being validated on the network, so that
right.
they try to cap the threshold of staked assets. Let's say 50%. Today it's 34%, but might go to 50%. And at some point they'll try to cap it so that the rest of the ETH are not staked, but they're used in lending protocols, liquidity providing, perp stacks. They use in the real blockchain economy, if you will. So
Yeah.
coming back to your questions, how do you evolve from a staking company to a yield company? You don't say, okay, staking is going to disappear. Staking is going to always be there, and it's going to be the base layer for a native asset like ETH. But you can use staking positions in DeFi. You can use a liquid staking token through Lido or through your own liquid staking token and put it into lending, for example, which suddenly um, kind of buffer the fact that the staking rate is going down with a high interest, right? Because now you get this liquid staking token, you put it into DeFi, and you get a couple of percentage of interest more.
Yeah.
And that rate going down is buffered by what you can now do with products like Lido V3, in which we're participating, where Kiln is running the validators. We are working with Lido, which mints LST liquid staking token on our validators. We work with an asset managers, then put that LST into DeFi through our Vault infrastructure so that we can provide higher yields to our customers, right? For not at 2.5%, but most probably 3.5% to 4.5% to our customers. So that's how you evolve from just a simple staking product to a staking plus DeFi product, while the staking rate is decreasing, but DeFi can be bundled with staking rates. Now, you still have new chains. You have much less new chains that we used to have in
Yes.
2023, 2024, 2025, where you had a lot of these TGEs, right? New blockchains were emerging, and blockchains are like startups. Some of them will win, and most of them will die. But what you see this year is more permission type of blockchains that are permissionless in the application sets, but permission in the validator sets, and that are very much application specific. And the good example is Arc from Circle, or Tempo for like the Stripe blockchain,
Yeah.
where they tell the world will be focusing on payments, because this is one of the biggest, if not the biggest, use case in on blockchains. Or Anton network that is focusing on privacy, because they say, well, if institutions want to tokenize assets, they better have a private way to do it. And running these chains is usually more complex as a staking provider, as an infra provider. So that's kind of our edge. The new chains are becoming more complex. It's not only staking, but usually you need to build all infrastructure around it for our customers. So that's how we stay on top of the curve. But otherwise, we bundle the staking rates with more DeFi rates.
Okay, interesting. And then a related question. Um, you see a lot of well, we're talking about like how the industry is developing, right? And one other consequence that we see of this is market consolidation. You see a lot of mergers and acquisitions. You see margins getting compressed. But another thing you also see is that players that were traditionally in different subsectors are starting to push into each other's domains, right? Especially like custodians, exchanges, prime brokers. They're starting to offer similar services that traditionally only the other categories out of that sentence would do. How is how do you navigate that dynamic?
Right. I think you touch a point. You There's increasing consolidation in the market.
Yeah.
And there will be increasing consolidation. You could argue that there will be a handful of winners in the retail platforms, and most probably a handful of winners in the B2B institutional platforms,
Mhm.
and some platforms that will do both, right? Coinbase is a very good example of like a good platform doing both.
Yeah.
Or um, Robinhood is trying to launch a B2B arm and so forth. But when you are a retail or institutional platform, then you need to offer everything. And offering everything in crypto is um, buy and sell. The first thing someone does with crypto assets is like, have fiat, I buy or sell my assets. Then I should custody it, and then I could earn it, which is staking in yield in general, right? And there's not that many other use cases if you think about it. So the platforms, they're thinking either on the retail side or B2B side or both. How can I internalize all of these steps of the end user journey, whether it's retail or institution? And they either partner or they buy, I guess.
Yeah.
And I think you will see an increasing movement towards that environment and that consolidation. I think when it comes to Kiln and Railnets, we decided to stay on the earn buckets on the yield section. Um, but we decided to be full stack, and the only, if you will, full stack yield platform, because some of our staking competitors, they only do staking, and then they didn't really do DeFi lending, and then they even less do on-chain asset management, what we are doing with Railnet. So yeah, that's how we decided from the beginning. Okay, if we have to build for other platforms, either B2B or retail, at least we'll follow them along the journey of you want something in the yield bucket, we'll be able to offer you everything. On-chain, of course. It has to be non-custodial, it has to be on-chain, in which case we are there to serve them.
Yeah, I think intuitively that makes a lot of sense, because I can imagine that historically speaking, staking providers, I can imagine they think of themselves as sort of very technical engineers that offer like a very technical solution. But I think on the other end of that proposition, of that transaction, they're sitting a client who simply thinks in terms of, okay, I have these assets, I have this capital, it's sitting passively, it's sitting idle. Okay, let me at least stake it, then it becomes active. But they don't care about like the nodes and this and that. To them, the proposition is simply, I'm getting yield on this capital because it's fulfilling a function now. Um, so I think that shift intuitively makes a lot of sense, especially for your counterparties. Um, as that shift took place, right? You must have noticed also a evolution, let's say, in preferred networks, preferred custodians, the type of asset managers. What, because you started Kiln in 2017, right? Correct. And so that's been quite a while, and you must have noticed a shift. What was that shift telling you?
Right. So yeah, I think we started in 2017, but we are really in the yield space from 2020, 2021. Because
Yeah.
as I mentioned to you in the beginning of the podcast, we did like bunch of iteration and pivoting, and from CVs on chain to yield. But I would say from my perspective, since 2020, 2021, but even like observing the market since 2017 and 18, I think what we've seen is the staking rates and offerings went platform were retail from 2018 to 2020, 2021. You would stake if you had invested in a Solana ICO or Tezos ICO, and then you would choose a dedicated validator to do it. In 2020, 2021, you start to see, oh, well, Coinbase or Binance or Ledger is offering me staking directly with at a click of a button. It's much more comfortable. I don't need to go on a validated website to copy an address or whatever. I can just click, right? A much easier way to do it. And then I can do that on 30, 40, 50 networks. So that's what happened, to my understanding, from 2018 to 2020, 2021, 2022. And later in staking, you start to see liquid staking. So, well, I can have my position that is staked, which can be liquid and which can be bundled with other type of yields in DeFi. So that's one thing we've seen on a couple of networks. The largest one, Ethereum, Solana, and then we've seen also the number of protocols being important going down. Right? Because again, as I said, protocols are like startups. Potentially 30 protocols were imported in 2021, 2022, and now you potentially have a handful, 4 or 5 that people really like to stake and really looking at. And we also seen the emergence of DeFi. You could argue DeFi summer started in 2020, but it was very much of a retail market in 2020, as staking was in 2018, and it became an institutional market or platform market in 2023, 2024, 2025, essentially at the same time we built Kiln DeFi, where now you could do the same thing with staking on one click. You can allocate into Aave or you can allocate into Morpho and generate stablecoin yields. What will happen now, it's, as you said, because there's this convergence of platforms doing everything, and there's also this convergence of crypto platform being fintechs and fintechs being crypto platforms, right? Like Revolut having the same services as Coinbase and Binance, same as Robinhood, and Binance and Coinbase starting to offer stocks and other type of products, or Kraken, such as Revolut and Robinhood. So there's this convergence of fintech and crypto at this point, where that's why we building Railnet again is because we think all financial assets will be tokenized. And we think now the same handful of users will be able to access on-chain stocks, DeFi, or staking. And potentially real-world assets, DeFi, and staking inside the same structure, inside the same bundle product. Now I can have a diversified portfolio inside one click through a vault of a bit of stocks, a bit of private credit, a bit of money market fund, a bit of lending or liquidity providing, and a bit of liquid staking inside the same vault, right? And that's what I think is very, very exciting. And that's why we building Railnet and building towards the yield space in the coming years.
Yeah, let's talk a little bit more about Railnet, because you guys announced pretty recently. The app was announced, I believe, this week as well. Before that, like, what were like the most specific pain points that made you realize, like hearing from your counterparties, your customers, your clients, that made you realize that just being a staking provider wasn't enough anymore, as you illustrated throughout this talk? And that the market needed something that is closer to what you are moving towards now.
Mm-hmm. Yeah, I think it's customers, but it's also investors. When you fundraise, they're like, "Oh, you should do more than staking." At some point, it's going to be a very mature market. It's going to be hard to grow, which is kind of happening now. As I mentioned, as I shared, the staking percentage or rates are being capped so that there's no more than 50% of Ethereum that are staked, 60 or 70% that Solana are staked. So it's the market is not doubling year on year. You're kind of like linked to crypto prices. So if crypto prices go down, well, you make less revenue. If they go up, you do more revenue. But the market is already very mature. So you can win new deals. Sometimes you can win deals over competitors, but then it's kind of a capped market. So I think we understood that very early on, either from our customers, but also from our investors and from just looking at the market. And we thought, okay, but staking will always be there. But what is like a doubling, tripling market year on year? Well, stablecoin. Because stablecoin doesn't touch only speculative assets, but it touches payments and daily usage. And last year, stablecoin supply went from 150 billion to 300 billion, and potentially it's going to double this year as well. And this market needs yield, on-chain yield. So we're like, okay, this seems to be a very interesting thing to tap on. The other thing to tap on as well is Bitcoin, if you think about it, because for pre-FTX reasons, you had yield on Bitcoin, were off-chain with centralized lending desk in the case of Genesis. And when FTX blew up, then the old Bitcoin yield market kind of blew up as well, with the trust into can I generate yield on Bitcoin. Then you had Babylon restaking on Bitcoin, which kind of gave a bit of hope to Bitcoin holders. Now I can get yield there. But nobody at some point would pay to take Bitcoin as a collateral to secure other blockchain networks that narrative, as well as an eigenlayer narrative, the restaking narrative, kind of faded away. But now what you can do is you can take Bitcoin and completely on-chain and allocate it, allocate it into the DeFi ecosystem and more sustainable real-world assets. So you can start to generate 3 to 6% yield on Bitcoin on a market that is completely immature in the yield spectrum, because it's not natively yielding. Sorry, it's not like staking assets, right? Like Bitcoin, you cannot stake your Bitcoin. So I think less than 2% of Bitcoin are getting yield versus 60, 70% Solana and close to 50% soon on Ethereum. So this is another very huge opportunity with what you can do on chain today and what you couldn't do on chain 2 years ago.
Interesting. Okay. And beyond that, Railnet, tell us a little bit more, like why, like how does it compare to other, what are the other offerings that it is competing with in your mind? And why would asset managers or the custodians, exchanges, why would they choose to use Railnet rather than the existing solutions?
Yep. Yeah. So I think as I was telling you, when we distributed stablecoin yield through lending in 2024 and 5 through Kiln DeFi, now at peak Kiln DeFi had like $700 million TVL in less than 12 months. So because the wallets like Ledger, Safe, Trust Wallet, Crypto.com Wallet would offer stablecoin yield through lending protocols via Kiln DeFi. So we were like, okay, there's Aave, which is its own on-chain asset manager, if you will. That's what Aave is to our eyes, is they are managing lending pools themselves. And then there's Morpho, which is like, or Uller, who are lending markets through vaults, where they push other curators, as they call themselves, to launch vaults and curate their own markets.
Mm-hmm.
And that's where we thought, okay, the vault thing is very interesting because essentially it's an on-chain fund. It's a fund where you can wrap different type of assets in a non-custodial manner and distribute yield to an end user anywhere in the world. But the vault of Morpho and Euler were very DeFi native. They were thought for synchronous flow positions, meaning that when you can go in and out of Morpho or Euler, you can go in and out in a purely liquid way, right? But we thought, okay, in the future, most of the yield will come from real world assets, the real world yields.
Yeah.
Money market fund, private credit fund, stocks, commodities, private equity, real estates. The world is going to be on chain, right? That's the whole premise, and that's coming now. So how can we build a standard that is different than 4626, which is what the standards of Morpho are using, which takes in consideration these liquidity constraints of real world assets. If you take real world assets, they always have a common trait, is that they have liquidity concerns. A money market fund is unliquid off chain of 1 or 2 days. Private credit fund is unliquid off chain by 3 months. Private equity fund is unliquid off chain by a couple of years. So what Railnet does is that it takes any deposits or redemption flows, it takes these durations, if you will, it takes this liquidity concern and it injects it into a smart contract, into a standard, so that an asset manager can say, well, through that standard, I can the same way interact with a liquid position on Aave, Morpho, Uniswap, or an illiquid position into BIDO, money market fund, ACRED, private credit fund, or NVIDIA or Tesla stock. And I can wrap it inside the same vault so that I manage liquid durations and positions illiquid positions in real world assets. And when it comes to illiquid positions, because through the smart contract, through the standard, I know exactly, I see the ticking time of when I did allocate it into ACRED, for example, private credit. And ACRED by design is 3 months. But if the asset manager allocated a month and a half ago, well, this position is still a month and a half liquid. And what the asset manager can do is they can trade that a month and a half non-liquid ACRED position to a market maker or to another asset manager to suddenly create more liquidity on these illiquid real world assets position, right? So what Railnet does, it's a standard that combine liquid DeFi and liquid real world assets position inside the same vaults. So you have better yield products, more diversified on-chain portfolios. That's one. And second, it's because all these real world assets are unliquid, it creates early liquidity with having better visibility in markets on these durations. I hope I wasn't too technical or kind of losing you, but this is why we kind of very excited about Railnet, because we think we're really building for what's next coming on chain.
Yeah, that's fascinating, and that's a very appealing value proposition, right? That's a true unlock. That's absolutely clear. Real quick, CoinShares and Monarch are your first asset managers on Railnet. Why did you choose to go with them, and why do you think they chose to go with you?
Yep. Well, I mean, we said, okay, if we want to bring something different, and if this strategy is going to be heavily indexed by real world assets, we need to go into the ones that understand these assets. So private credit fund, money market fund, more than the creators today in DeFi. The creators, they understand DeFi and looping very, very well, lending and looping. But the traditional asset managers, they understand like what's a private credit fund or money market fund for years. That's what they've been doing off chain, but now it's being tokenized on chain. So I was like, okay, if we want to find the best portfolio manager and like apply them on chain, we need to find them off chain and push them to launch vaults. So that's why CoinShares as well, they are at the intersection. They are the largest crypto asset managers in Europe off chain via ETPs and ETF. They MiCA compliant, now NASDAQ listed. And they're like, well, they understand real world assets better than most of the creators. So like, and they also come with kind of a fiduciary duty where they have a large balance sheet. Black swan events can happen in DeFi, and at least you can trust their brand. So it was a natural fit. We, of course, also very close to the team, and I was building with Jean-Marie, the CEO, for years. They were using us for staking on their ATP. So that's how we know them. When it comes to Monarch is kind of the same. We thought was one of the best crypto native / TradFi team in the market, and they were operating Bitcoin off-chain strategies for years, and we kind of pushed them to launch these vaults and say, well, you better launch these vaults because we will be able to do what you've been doing off-chain with DeFi and real world assets to millions of customers, because now it's going to be on-chain. So this is how we picked them, and I think they picked us because, well, you know, they potentially we were nice enough, funny enough. we had the distribution. So yeah, I think it's a combination. Yeah, I mean, you need to be nice. I guess you need to be smiling.
I think you're being too modest. I think you guys have an amazing track record, and that must be part of it as well. And it's very exciting what you said, that it makes sense. Like, building for the future that we're building towards, you need more traditional asset managers, right? Or risk curators, or however you want to call them. So in that sense, you have a very future-proof partnership going on here. So that's very exciting. To wrap it up, if listeners want to learn more, of course they can go to Kiln.fi, Fi,
That's right.
and realnet.org. Is there anywhere else you recommend them to go to connect?
Yeah, I think they can go to app.realnet.org now. We just launched our public app last week, where they can see Monarch products or conscious Onchain products. And they can just like reach out to me on Twitter, LinkedIn, though LinkedIn is a bit noisy these days, but yeah, feel free to reach out. I'm also very often in conferences, as you might be as well, Stefano. So I'll be in New York next month, and I'll be just attending these conferences is always a pleasure to do that. So if you see me around, just bump into me, and I'll be happy to chat.
Lovely. It's amazing. Great talking. Very exciting for the future of, well, not even of staking. It has morphed into something completely different. On-chain yield, I suppose you could call it rather. It's very insightful, very exciting, and inspiring. So thank you for coming on.
Thanks, Stefano. Thanks for having me. From hospitality to on-chain asset management.
All the way.
You can do it. But no, thanks for having me. I think I had a blast, and thanks for your great questions.
Thank you, man. To our audience, we hope you enjoyed it as well. This was Market Cap, where we feature firms and funds to explore the thinking that guides them, the patterns they observe, and other forces moving the markets. See you on the next Market Cap.
If you enjoyed this episode, you can find more of our research in the following ways. For in-depth reports, many publicly accessible, join our research platform. For protocol and market summaries and highlights, subscribe to our newsletter. And for our next episode, follow us on X and YouTube. All links in our bio.